Today we've come to the closing meeting of the Open Market Committee of the Federal Reserve for the year. And it's been perhaps one of the more surprising of the year because here we are in mid-December and the Federal Reserve has invited Goldilocks to Christmas dinner. Because in terms of the outlook provided by the summary of economic projections released together with the meeting, everything about the US economy is just right, just like in the Goldilocks story. And we'll talk about what that detail means in a second. But the response of the market to the idea that the Fed thought everything was just right was to exploit a bit of that extra liquidity we were talking about in the previous video. And markets today are very strong. But is that strength justified? So let's look at what the Fed actually said today in terms of its outlook. Now, this is the summary of economic projections. And it's not the committee, it's not the official committee view. What happens is that the participants in the Open Market Committee put down their individual estimates. Some of them are from the Federal Reserve in Constitution Avenue in Washington, D.C., and some of them are presidents of individual banks. So their own research people give them the forecast which they put down. These are the best that the Fed provides. But these were amazingly friendly to the market. So for this year, the Open Market Committee of the Federal Reserve, Summary of Economic Projections, believes that growth will be 2.6% in the US economy. That's slightly better than our own estimate of 2.4%. It falls next year to 1.4%. But that's the low for the next few years. That might slow down to 1.4% growth because it kicks up in 2025 to 1.8%, and then in 2026, 1.9%, and in the longer run, which means 2027 and beyond, the average is 1.8%. Unemployment, which currently is at 3.8%, up from a low of about 3.5% earlier in the year, increases next year to 4.1%, but goes no higher than 4.1%. And that is, by definition, a soft landing. That unemployment in 2024 is 4.1%, 2025 is 4.1%, and 2026 is 4.1%, and stays there in the long term. So in the long term, the Federal Reserve or the members of the Open Market Committee believe the labour market will be in balance. Importantly, since their job is to bring down inflation, the PCE deflator, that's to say the headline, now remember PCE inflation, personal consumption, expenditure, inflation is usually 0.5% below the CPI. So this year we'll finish at 2.8%. That's similar to 3.3% for the CPI. Next year, 2.4%, similar to 2.9% for the CPI. In 2025, 2.1%, similar to 2.6% for the CPI. And by 2026, it gets down to 2%, which is 2.5% for the CPI, which means it's hit the target by 2026 and it stays there. Core inflation, a little bit higher than the headline. With core PCE, it's 3.2% this year. Again, that's like core CPI of 3.7. Core PCE next year is 2.4, and then falls to 2.2. And then by 2026, it's 2.6 core PCE or 2.5%. So it hits the target by 2026. And as a result, the result of these very optimistic numbers is that the Fed funds rate falls next year and keeps falling. That from a level of 5.4% now, it's actually 535 basis points. The Fed funds rate falls to 4.6 next year, and that means 3 rate cuts next year, and then 4 rate cuts the year after that to get to 3.6%. 3 rate cuts the year after that in 2026 to get to 2.9%, and it's only in 2027 that the Fed funds rate, which is, remember, 2027 is 4 years away. By the end of 2027, that it gets down to the final target of 2.5%. So over a long period of time, the Federal believes that rates are going to decline back to where they started from, about 2.5%. And as a result of that, the market believes, as the result of these cuts year after year, that bond yields will fall, and so markets around the world are very strong today. But there's a problem with this scenario. One of the problems is that is the budget deficit that we've been talking about for the last year. And we've been saying that the reason that the US economy didn't go into recession and it's a soft landing is because there is so much budget stimulus. The budget deficit, again, this year is 8.35%, and it stabilizes for the next few years at 7%. Now, Larry Summers, who used to be in the Clinton administration, he was the Secretary of the Treasury, after that became president of Harvard. Larry Summers, together with Olivier Blanchard at the Peterson Institute, in their work, say that with those kind of big budget deficits, you can't get a Fed funds rate down, ever get the Fed funds rate down again to 2.5%. Matter of fact, they think that the Fed's run equilibrium will be about 4% with that kind of a budget deficit. And that means that rate cuts, decline in rate cuts runs into a brick wall in 2025, only 2 years away. So for that reason, you've got perhaps less decline in the Fed funds rate than the committee suggests. And that kind of rate of about 4% is consistent actually with the long-term Fed funds rate. If we go back in the data for the last 55 years, back to 1970, the average Fed funds rate is 4.88% and the median is 5%. So long-term rates are usually a bit higher, or most actually they're twice as high as where the Fed is suggesting that rates will decline to in 2027. So that's the first thing, the problem we have. The second thing we have, the problem we have in the scenario is that definitively, as part of this outlook, that quantitative tightening continues. What is quantitative tightening? Quantitative tightening is the Federal Reserve is allowing its holdings of Treasury securities to run off into the market. Now, where they started with Treasury securities, as a result of all the quantitative easing that they did, the purchase of bonds to keep bond yields lower, in April 2022, they wound up with a peak holding of $8.9 trillion US dollars worth of bonds. Since that time, in the year and a half since that time, they've let that decline to $7.7 trillion dollars worth of bonds, about, say, a little less than $1 trillion a year. But let's say they can run off $1 trillion a year. What the Fed chair said today was that he thought that there was an excess funds, or that they would have to run down another $3.5 trillion worth of these bonds they were holding. What will happen is that banks, instead of buying corporate bonds and supporting investment in the US economy, will buy Treasury bonds. And that will squeeze out bank investment in US Treasury bonds, and that reduces investment in the US economy. So that's the reason this is actual genuine tightening. And year by year, as we go forward to 2027 and it could be 2028, before all these bonds are sold, you'll have this continuous tightening in the US economy and investment in the US economy because of this sell-off of bonds. Now, the only way that can be rectified is by foreigners buying bonds, and for foreigners to buy the bonds, it's probably that the US dollar is going to be moved down significantly from current levels to make those bonds cheap enough for foreigners to buy. So we think it's wonderful that the Fed has generated this outlook out to 2027, in which unemployment rises only modestly to 4.1%, and the Fed funds rate falls from the current level of 5.4% all the way down to 2.5%. But we think there are very good reasons why that's not going to happen. One is the average level that Fed funds rates have actually traded at for the last 55 years. The second is the work of Summers and Blanchard, that to finance these really big budget deficits that we have, interest rates are going to have to stabilise. That is to say, the Fed funds rate is going to have to stabilise at a touch over 4% in coming years instead of the 2.5% that the Fed believes. But hey, those problems mightn't emerge until the end of 2025. So for the next couple of years, we can believe that, just as the Fed suggested today, that Goldilocks can come to Christmas dinner, and we can all be optimistic about the future for next year and the year after.